It happened yesterday. On Friday afternoon, the Department of Justice quietly ended its criminal investigation into Federal Reserve Chair Jerome Powell. 6 months of pressure. Subpoenas the courts called thin and unsubstantiated. A federal judge who said the prosecutors had produced essentially zero evidence. All of it dropped on a Friday afternoon, the way controversial decisions always get dropped, 4 days before the May FOMC meeting. That single decision changed everything, because dropping the Powell probe cleared the last roadblock to Kevin Warsh's confirmation as the next Fed chair. Senator Thom Tillis had vowed to block Warsh until the Powell investigation ended. The investigation just ended. Powell's term expires on May 15th. The Senate is now on track to install Trump's hand-picked Fed chair within weeks, against the backdrop of a president openly demanding rates be cut from 3.6% to 1%. Read that number again, 1%. With CPI running at 3.3%. With oil elevated from the Iran conflict. With $160 billion in tariff refunds beginning to flow back to importers because the Supreme Court ruled the president's signature trade policy unconstitutional. With the current Section 122 tariffs set to expire on July the 24th, unless replaced by 76 ongoing Section 301 investigations. This is not a normal moment in American monetary history. This is a constitutional, political, and monetary collision happening in real time on a tight calendar, and gold is the asset that has historically priced exactly this kind of collision. Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through the three converging forces that just reignited the safe haven trade in gold. I'm going to explain why the tariff situation isn't a trade story anymore. It's a fiscal story, and fiscal stories drive gold differently than trade stories. I'm going to show you exactly what changes at the Federal Reserve when Warsh takes over, and why the bond market is already starting to price it. And I'm going to give you the 4 signals that will tell you whether the next leg in gold is days, weeks, or already underway. Quick favor before we go further, subscribe. If you want clean breakdowns when macro chaos hits an inflection point, not hype, not cheerleading, just the mechanics, hit the bell. These moments don't announce themselves. They announce themselves through the gold price and the dollar index. Let's get into it. Let me start with what just changed, because 3 different stories that markets have been treating as separate just collapsed into a single trade. Story 1. The Supreme Court ruled on February 20th, 2026, in Learning Resources Incomers vs. Trump, that the International Emergency Economic Powers Act does not authorize the president to impose tariffs. The decision was 6-3. It invalidated the so-called Liberation Day reciprocal tariffs from April 2025. It invalidated the fentanyl-related tariffs on China, Mexico, and Canada. The federal government had collected $166 billion from more than 330,000 businesses under those tariffs, and on Monday this past week, April 20th, the Customs and Border Protection portal opened for refund claims. Citi has already calculated that Walmart alone is due $10.2 billion, Target $2.2 billion, Nike $1 billion. The total refund liability exceeds $160 billion, and it has to come out of the same treasury that's already running a $1.9 trillion fiscal deficit for 2026. Story 2. To replace the tariffs the Supreme Court struck down, the administration invoked Section 122 of the Trade Act of 1974, which allows a 10% blanket import surcharge for 150 days. That clock started in February. It ends July 24th. After that, unless Congress extends it, the 10% blanket tariff disappears unless replaced. To replace it, the U.S. Trade Representative launched 76 new Section 301 investigations on March 11th and 12th, covering 99% of U.S. imports. Treasury Secretary Scott Bessent said publicly last week that the tariffs could be back in place at the previous level by beginning of July. Read that as, the administration intends to recreate the IEPA tariffs through a different legal mechanism on a deadline that lines up with the expiration of Section 122. Story 3. On April 21st, Kevin Warsh testified before the Senate Banking Committee for his confirmation as Fed chair. He testified that his priorities would be a return to a strict 2% inflation target, a smaller Fed balance sheet, an end to forward guidance, and an abandonment of the dot plot. Senator Thom Tillis blocked his confirmation pending resolution of the Powell investigation. 3 days later, on Friday, April 24th, the DOJ dropped the Powell investigation. Warsh's path is now open. Powell's term ends May 15th. 3 stories, 3 calendars, 3 deadlines, all stacked into the next 90 days. Now here's the part the financial press isn't connecting. Each one of these stories independently is gold positive, but the market hasn't priced what happens when all 3 execute in sequence on the same calendar. So here's the first lesson. Gold is not pricing a single event. Gold is pricing a regime change in which the largest economy in the world simultaneously pivots its fiscal policy, its trade policy, and its monetary policy under conditions of constitutional friction. That has never happened in modern American history. There is no clean historical comparison. The market is being asked to price something it doesn't have a template for, and when markets don't have a template, they price uncertainty by buying gold. Let me get more concrete about why the tariff story is now a fiscal story. The administration has been using tariff revenue to fund part of the fiscal deficit. The 2026 fiscal year is projected to collect somewhere between $300 billion and $400 billion in tariff revenue, based on current rates. That revenue has been flowing into the Treasury and offsetting some of the $1.9 trillion deficit. Now, $160 billion of that revenue is flowing back out to importers as refunds. The blanket 10% Section 122 tariff expires in 3 months, and the Section 301 replacement tariffs require formal investigations, public comment periods, and hearings. The manufacturing-related hearing is scheduled for May 5th. The forced labor-related hearing was April 28th. Even if the administration moves at maximum speed, there's a legitimate gap between the expiration of Section 122 in late July and the imposition of Section 301 tariffs that would replace them. In that gap, the tariff revenue stream collapses. The fiscal deficit widens. The Treasury has to issue more bonds to cover the gap. The bond market has to absorb more supply. And the people who have to buy those bonds want to be compensated for the risk that the next administration is willing to use legally questionable tools to fund the government. That's not conspiracy. That's what tariff refunds, plus a temporary tariff, plus an uncertain replacement, plus a $1.9 trillion deficit actually mean for the bond market. And what's bad for the bond market is historically very good for gold. Now look at the political pressure on the Fed. President Trump went on CNBC's Squawk Box on the morning of Warsh's confirmation hearing and said he would be disappointed if Warsh didn't immediately cut rates. The current federal funds rate is approximately 3.6%. Trump has been demanding a cut to 1%. No Fed official supports that. The committee that actually sets rates is 12 people, not just the chair. And the rest of the committee has been clear that with inflation at 3.3% and oil elevated, cuts of even normal magnitude are not justified. But here's what happens politically when a chair is installed under pressure. The chair doesn't need to publicly capitulate. The chair only needs to shift the conversation. Warsh, in his hearing, said something interesting that the financial press didn't focus on. He suggested that productivity gains from artificial intelligence might justify lower interest rates than would otherwise be warranted. That's a sentence with enormous implications, because it's not a commitment to cut rates. It's the construction of an intellectual framework that would justify cutting rates without admitting that cuts were politically motivated. If the Fed under Warsh adopts a productivity-driven framework, it can argue that AI-driven economic growth justifies lower real interest rates, even with elevated inflation. That argument doesn't require formally abandoning the 2% target. It just requires reinterpreting the relationship between inflation and the natural rate of interest. That's the kind of regime change that doesn't get announced on a Tuesday morning. It gets implemented through speeches, through dot plot revisions, and through gradual policy drift. Here's the second lesson. The Fed's independence isn't being attacked through a head-on assault. It's being repositioned through a cooperative reframing. Warsh isn't going to read scripts written by Trump. But Warsh is going to lead a Fed that finds intellectually respectable reasons to deliver outcomes the administration wants. And the bond market knows it, and gold knows it. Let me put the pattern under a microscope, because this isn't the first time American monetary policy has been politically repositioned, and the price of gold has memory. In 1971, Richard Nixon faced a similar collision of political pressure on the Fed, fiscal stress from war spending, and an unsustainable currency arrangement. His response was to close the gold window and dollar convertibility and impose price controls. Within a decade, gold had risen from $35 to $850. The currency lost most of its purchasing power. The bond market repriced everything, and the politicians who were responsible were either out of office or politically destroyed. In 1977, Jimmy Carter appointed G. William Miller as Fed chair under intense political pressure to lower rates and stimulate the economy. Miller cut rates aggressively. Inflation accelerated from already elevated levels. By 1979, the dollar was in a crisis. Gold had tripled, and Carter was forced to replace Miller with Paul Volcker, who then had to raise rates to 20% to break the inflation that the political pressure had unleashed. Volcker succeeded, but only because the debt at the time was small enough to absorb 20% rates. That's not the situation today. The pattern is political pressure on the Fed creates monetary accommodation. Monetary accommodation creates inflation. Inflation eventually requires either crushing rate hikes or currency devaluation. Crushing rate hikes are not possible at $39 trillion of debt. Devaluation, mechanical or political, is the remaining option. And gold prices devaluation in advance. Is that proof gold goes higher? No, I'm explaining incentives and mechanics, because incentives matter. When the administration is pushing for rate cuts the data doesn't support, when the new Fed chair is being installed under conditions that compromise the appearance of independence, when the tariff revenue base is fracturing, when the deficit is widening, when foreign central banks are reducing treasury holdings and accumulating gold instead, every one of these trends is independently rational from the perspective of the actor making the decision. The administration wants growth. The chair wants the job. The central banks want diversification. None of them are conspiring. They're each pursuing their own incentive. And the cumulative effect of all those rational decisions is a monetary system shifting toward outcomes that gold has priced for centuries. So ask yourself, when the political pressure on the Fed is this explicit, when the tariff funding mechanism is this fragile, when the deficit is this large, when the inflation backdrop is this uncertain, and when the new chair is being confirmed on this kind of timeline, what does a 10% correction in gold from its January high actually represent? Distribution at the top or accumulation in the middle? Now let's read the current action like a forensic report. Gold is trading near $4,138 today, down from the $5,409 down all-time high on January 29th. JP Morgan has a 2026 target of $6,300. Yahoo Finance's analyst consensus has clustered around $5,500 to $6,000 by year-end. Fortune notes some experts targeting $7,000 in extreme dollar stress scenarios. The institutional range is $5,500 to $7,000. The current price is $4,138. The gap between current price and the conservative institutional target is 16%. The gap to the high-end target is 48%. In a correction that was the actual top of a multi-year run, you would expect the institutional consensus to be revising downward. It isn't. JP Morgan raised its target. Bank of America's commodity desk is constructive. Even traditionally cautious analysts have been adjusting upward, not downward. That's not the pattern of a top. That's the pattern of a market that has paused while the structural drivers continue to develop. You would also expect central bank purchases to slow. They haven't. The World Gold Council's data through Q1 2026 continues to show sovereign accumulation at multi-decade highs. China's official reserves have continued to add gold. Emerging market central banks across Asia and the Middle East have continued to allocate. The European Central Bank is now openly discussing gold's role in the international monetary system in a way it hasn't in 2 generations. You would expect ETF flows to reverse decisively. They haven't. SPDR Gold Trust holdings have fluctuated but remain elevated. Sprott's Physical Gold Trust has continued to attract capital. The behavior of institutional gold buyers during this correction has been hold and accumulate, not sell and reposition. Every structural signal is pointing in the opposite direction from the paper price action. That divergence is the signature of a correction that is pausing, not a top that is completing. So here's the cliffhanger. The next 90 days bring an unprecedented sequence. The May FOMC meeting on April 28th to 30, the Powell to Warsh transition on May 15th, the Section 301 manufacturing hearings on May 5th, the expiration of Section 122 tariffs on July 24th, and the simultaneous flow of $160 billion in tariff refunds back through the Treasury system. Every one of these is a potential gold catalyst. The probability that all of them resolve neutrally is small. The probability that at least 2 of them produce a measurable monetary or fiscal shock is high, and the gold market is currently priced as if none of them matter. Let me put the macro picture in context, because gold doesn't trade in a vacuum. The Iran ceasefire was extended this week, but negotiations have collapsed again. Iran continues to restrict the Strait of Hormuz. Oil remains elevated. The dollar index has been volatile in a wide range. Bond yields at the long end have been climbing slowly, while short rates remain anchored. The yield curve is starting to steepen in a way that historically signals fiscal stress repricing. The S&P 500 hit a new all-time high in mid-April on AI-driven euphoria, which means the equity market is pricing perfection at exactly the moment the macro picture is pricing chaos. That divergence between equity and gold is itself a signal. Historically, when equities and gold rally together, gold leads the next regime change. And right now, gold is leading by every measure except short-term price. Here are the 4 signals that matter more than any headline you'll read between now and the July 24th deadline. 1. The Warsh confirmation timeline. With the Powell probe dropped on April 24th, the path opens for a Senate Banking Committee vote within days, followed by a floor vote that typically takes another 2 weeks. If Warsh is confirmed before May 15th, the transition is smooth and gold may consolidate. If the timeline slips and Powell's term expires before a confirmed successor is in place, the Fed enters a brief leadership vacuum that historically produces volatility spikes in gold. 2. The May FOMC decision and statement on April 30th. Markets currently expect rates to be held steady. Watch the language of the statement and the press conference. If the Fed signals openness to cuts based on growth or productivity arguments rather than inflation, the bond market will reprice and gold will respond within hours. If the statement is hawkish, gold pulls back temporarily, but the structural drivers remain. 3. The Section 301 timeline. Watch for any announcement of preliminary tariff determinations from USTR before the May 5 hearing. If the administration tries to accelerate the Section 301 process to bridge the gap from the Section 122 expiration, expect legal challenges to follow within days. Each legal challenge is a potential safe haven trigger. 4. The 30-year Treasury yield. Watch the 30-year specifically. If long-end yields rise above 5.5% on tariff or fiscal concerns, the bond market is pricing a Treasury supply problem. If long-end yields fall sharply on Fed expectations, the bond market is pricing recession. Either move is gold positive for different reasons. The signal is the magnitude, not the direction. Now I'm going to ask you 2 questions, and I want your honest answer in the comments. First, give me your gold price by July 31st, 2026. The moment the Section 122 deadline passes and the Section 301 tariffs either land or don't. 5,000, 5,500, 6,000? Or does this resolve lower, back to $4,400 or below? Drop your number, drop your reasoning. No hedging. The July 34th date is concrete. Your prediction can be checked. Second, if you had to pick one of these 3 risks as the highest probability gold catalyst between now and July 24th, Warsh's installation triggering a dovish Fed, the Section 122 expiration producing a tariff revenue gap, or tariff-related court ruling blocking Section 301, which would you pick and why? This is the question that will produce the most intelligent comment thread on your channel because it forces the commenter to think through 3 converging timelines simultaneously. Now, what should you expect next? Expect volatility. The next 90 days have more concentrated macro catalysts than any 90-day window in the last decade. Gold may chop between $4,500 and $5,000 for weeks. Don't confuse that chop with a top. Expect narrative attempts to shake confidence. You'll see them intensify. You'll read articles arguing that the tariff situation is resolved by Section 301. You'll hear analysts say Warsh is a market-friendly choice who will preserve Fed independence. You'll see commentary suggesting the safe haven trade has run its course. Recognize the pattern. Every one of those narratives needs to be true simultaneously for the bearish gold thesis to work. The probability of all of them being true at once is very low. And expect opportunity to appear exactly where fear is concentrated. The $4,500 to $4,800 range in gold will look like weakness on the chart and accumulation in the structure. The difference between those readings is the difference between trading the move and being positioned for it. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what's happening right now with real news from this week. The Powell investigation was dropped on Friday. Warsh's confirmation path is open. The Section 122 tariffs expire on July 24th. The $160 billion refund process began Monday. The Section 301 hearings are in 9 days. The May FOMC meeting is in 5 days. Powell's term ends in 3 weeks. And gold is pricing as if none of these dates matter. Amateurs watch the gold price. Pros watch the calendar of converging deadlines, the yield curve, the central bank flow data, and the political pressure on the Fed. The amateur tape says gold is consolidating after a big run. The professional tape says gold is staging before the next regime change. Gold is a 5,000-year-old monetary asset that has priced every political monetary fiscal collision in recorded history. It priced Diocletian's currency debasement. It priced Henry VIII's coin clipping. It priced the abandonment of bimetallism. It priced the closing of the gold window in 1971. It priced the Volcker disinflation in reverse. And it is now pricing the simultaneous repositioning of American fiscal policy, trade policy, and monetary policy under conditions of explicit political pressure on the central bank. So here's the clean summary. The DOJ dropped the Powell probe on Friday, clearing Warsh's path. Powell's term ends May 15th. The May FOMC is on April 30th. Trump is publicly demanding rate cuts to 1%. The Supreme Court invalidated $166 billion of tariff revenue. $160 billion in refunds began flowing this week. The Section 122 backstop expires July 24th. 76. Section 301 investigations are racing the clock. The CPI is running at 3.3%. The deficit is $1.9 trillion. Central banks are accumulating gold at multi-decade highs. JP Morgan's gold target is $6,300, and gold is trading at $4,138. This is where the serious holders of monetary assets separate from the tourists. The tourists watch the price. The serious holders watch the calendar. If you want the next breakdown, The moment the FOMC speaks, the moment Warsh is confirmed, the moment Section 122 expires, the moment the next gold catalyst lands, subscribe. These events don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the next move before the headlines do. Drop your July 34 gold target in the comments. Tell me which catalyst you're watching most closely, and I'll see you in the next one.